Welcome to another accounting video. I'm your host, Professor Capko. In a prior video, we showed a transaction in which $1,500 worth of widgets were purchased from you in cash. In this video, I want to show the exact same transaction, but instead of the customer paying cash for the widgets, they're going to owe you the money. It's going to go on their accounts receivable for you, that they owe you, and then they're going to pay you in a later date. So let's show that transaction for credit. So you're going to make the same entry for the sales revenue T account. And since sales revenue is one of your income statement accounts and it's a revenue account, it goes up with credits and down with debits. So it's an increase in this account by $1,500 because you make the sale, and you would record this at the time of the sale. And because they're not paying you cash, if you recall in the prior video, we debited cash for that $1,500. But we're not receiving any cash at this moment, but we are receiving an asset, and that's a promise to pay in the future. So that's going to be in our accounts receivable. Accounts receivable. And that is an asset account, so it increases with debits and decreases with credits. We'll keep that in mind. So that's our accounts receivable account, and I'm just going to do a general one, but generally a company would have specific accounts receivable for each and every, break it down, sub-accounts for each and every customer that owes them money. We're just going to have a general accounts receivable account for this for demonstration purposes. So I'm going to put a debit for $1,500. Again, this is recorded at the time of the sale. At the time of the sale, this is recorded. So we still have our sales revenue going up by $1,500. And now this other asset, accounts receivable, reflects the $1,500. And so therefore this transaction is balanced because we have a debit for $1,500 and a credit for $1,500. Then let's say the customer, after receiving the goods, goes ahead and makes their payment. So they're going to pay the $1,500 that they owe. And for our purposes, we're going to pretend there's no interest or discounts or anything like that. So they're going to pay cash. So I would go ahead and put the cash account up here, the T account that you're familiar with. We did last time. And it's an asset account, so it goes up with debits and down with credits. And they make the payment for $1,500. So I'm going to reflect the $1,500 here. That is our debit for $1,500. But because we have dual entry accounting, we have to have an offsetting credit. Where do you think that credit's going to go? We have to have an equal $1,500 credit. That is right. We're going to credit accounts receivable for $1,500. So we have a debit of $1,500 for cash and a credit for $1,500 for accounts receivable. And why do we do that? Well, you can see we had debited $1,500 here for accounts receivable. We added $1,500 to it, in other words, and then we're crediting it. We're backing that out. We're subtracting $1,500 here. So for purposes of the account receivable, we now have zero owed, right? This asset has gone to zero because we added $1,500 and then we took $1,500 back out of there. So there's $0 in the accounts receivable account. However, our cash account, which is also an asset account, grew by $1,500, which is a perfect offset for that. Our sales revenue at this point is not affected. We've already recorded that sale at the time that it was made. I hope you found this helpful. Look forward to doing some more accounting videos for you. If you like this video, go ahead and smash the like button. Please put a comment below if you have any additional questions or if there's particular problems you want me to do. Also reach out to me if you would like some private accounting tutoring. I will put my email address in the comments section and you can reach out to me. Also, please don't forget to keep your grade alive and subscribed.